Something's not quite adding up here. We knew that there was a bearish divergence headed into this week's worth of trade, but now that we've got a day's worth of pullback, it's not exactly clear what the market's trying to do next. It's my belief that the markets are still mostly aligned with the bullish base case. However, I'll show you where I have some open concerns and what I'm going to do about them. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY daily time frame chart, and I'm very intentionally leaving it zoomed out, just so we can remember that previous lows from way back over here acted as resistance. And if we remain above those previous lows, which then turned into previous highs over here, then I would still maintain a bullish stance on the SPY daily time frame, because the trend, of course, remains in the upward direction. Soft higher low, soft higher low, soft higher low. This is a firm higher low at the daily 200. We've been talking about this. Soft higher low here, soft higher low on last Thursday's session because the hourly trend never flipped to down. And of course, as of this morning's gap up, we have highs, higher highs, and this morning technically produces a brand new higher high in the trend count. So once again, leaving it zoomed out for just another second, if the market pulls back to 595.15 on the daily time scale, that's still an opportunity for a higher low. Now let's get a little bit more granular, and I'm going to zoom in on this because I do have some concerns, as we've mentioned in the intro. The first concern is just that we did not get a gap fill reversal on today's session. When the market opens over a previous day's range, in theory, the best possible higher low on the bar-to-bar count is to remain outside of the previous day's range. So in this case, we would want to stay over Tuesday's high, produce a gap fill reversal, and go on to make higher highs, something that would have looked something along these lines right here. Now, clearly that didn't happen, and we did end up closing back inside of Tuesday's range. However, if we look at the low of today's session, we tested Tuesday's low, and there was no breakdown. I would think if we had stronger sellers participating in this market, it was a great opportunity to produce something like a bearish engulfing bar, where if we had closed underneath Tuesday's lows, maybe something that looked like this, solid red body bar, a little bit of a wick here, I would be much more open-minded to the pullback continuing all the way for the retest of 595.15 and perhaps things getting worse if this was truly going to kick off bearish momentum. But clearly that didn't happen, and of course the bar we're left with offers a close in the midpoint of Tuesday's range, and perhaps most importantly, remains over Thursday's high of last week. And the reason that this is so important is because it really goes all the way back to the QQQ divergence. If we go take a look at the QQQ really quickly, and today's episode will be a little bit more organic as we're working on limited Wi-Fi. Anybody who is out to the morning show knows what was going on there. Take a look at this NASDAQ. And again, the premise of this is referencing Thursday's high of last week. Notice the same thing. We do technically open on a gap up here in the NASDAQ thanks to the CPI report, but where do we close? We close underneath that Thursday high from last week. So in my view on the NASDAQ, this is starting to look much more like a look above and fail, and it's very possible that sustained lower highs underneath 533.25 offer some downside pressure to get back towards this area here at 522.50. Now, I'm not just blindly going to start shorting the NASDAQ here on the premise of look above and fail. I probably want to see an intraday lower high underneath 533.25 that offers decent risk reward along these lines right here. But if we just quickly flip back to the S&P 500, the issue starts to come up, and hopefully you can see where I'm going with this, right? If we just zoom back into, let's go ahead and get this front and center on the screen like this, so nobody has to squint at their little mobile phone, or if you're on desktop, it's just nice and pretty, front and center. I wouldn't really want to short the S&P into this level here. So if the NASDAQ is ultimately going for a look above and fail, but the S&P is cracking these lows and headed straight into support at 595.15, I get a little bit hesitant about becoming a large new money short in the S&P because this is a great spot for a daily higher low. So that's one of the contention points that I'm already starting to pick up on between the two major indices that doesn't really lead to a proper resolution, or I should say a confident resolution where the two are moving in unison, in sync. So what do I do about this? If I am going to short the S&P underneath the two equal lows back down underneath the Thursday high from last week, then I'm going to do so with reasonable size, and I'm going to manage my expectations. I'm not going to overstay my welcome on the short side if we start approaching 595.15 and it appears as though buyers are starting to step up, because we know that ultimately in an uptrend, pulling back from the highest high the market has the ability to produce a higher low and maintain the overall uptrend, right? So that's first things first between the two majors. If we drop this down now to the hourly time scale, there's another couple of nuances that I would really pick up on here. The first one is the first literal liquidation break from this morning's session. If you are watching intraday, you know that early on in the session, the market took a plunge straight to the lows and then basically retraced all the way up to the high of day. And in theory, that liquidation break should strengthen the market. Why? Because if we have stronger sellers, they shouldn't have just stopped at this previous pivot in here, which was the intraday high from Tuesday. You could see it was the morning low of the session at 602.50. If we had stronger sellers, what they should have done on the first attempt, right, is poke through that level, offer a lower high, and then get continuation. Now, obviously, later on in the afternoon, right around when there was a couple of things happening, the bond auction, though, in the afternoon, when this was taking place, right, the market did end up going through and offering a lower high on the second go-around. Now, that does open the door for potential shorts, and of course, the pattern that might be in force here is a left shoulder, bit of a head, and now any rally attempts that fail at 602.50 really turn into a right shoulder. Then what do we have? Well, a neckline breakdown underneath that 599.25 probably results in the Brigade bolt that's available to the short side into 595.15, like we were just talking about on the daily time frame chart. So it's a little funky to me, though, that this did act as liquidation break. We did get the 100% retracement, which means sellers initially failed, but then buyers failed back on the opposite side, clearly breaking down and closing underneath that morning set of lows. So in this zone, I'm a little bit hesitant to make a big bold bet here. I would think that the right shoulder can build out if we're under 602.50. The shorts start to come into play underneath the two equal lows from, of course, today's Wednesday, and then the Tuesday session low. You can see it's that Monday pullback into the afternoon as well. If we're underneath that 599.25, then risk reward like this makes some semblance of sense. But once again, don't overstay your welcome at 595.15. So when we get to 595.15, if you notice that the market looks like this perhaps, and we Brigade bolt underneath, then we start to pick up buyers down here, I would be thinking about the daily high or low opportunity as the primary base case to participate in, looking for longs off of 595.15 to then get back up to the retest of the neckline here at 599.25. Then any Brigade bolts back through that should start working their way towards the equal high, which is up here closer to about 605. It's really 604.90s if you want to use the high from today's session. So this path right here might start to become the primary watch into the remainder of this week, so long as price action remains underneath 602.50 early on in the session tomorrow. The only caveat there is that we do get PPI. As we saw from CPI this morning, it came in way better than the expectations. The market gapped up. That gap failed to hold initially, right? There's gap fill reversal, great. But then from there, liquidation breaks straight back to the lows. Same thing happening here into the afternoon. If PPI causes a gap up and the read comes in better than expected, I would start to entertain shorts if this was going to take place. So this represents the gap, not really a gap because we're still inside of today's Wednesday range, but if we open over 602.50, Brigade bolt for a lower high underneath 602.50, this trade here could be a very quick scalp off of the open. Okay, so that would persist with the bearish pressure, trying to build out that right shoulder and taking advantage of the right shoulder range to ultimately trade for. Where do we become bullish? Well, we already talked about the pullback to 595.15. I would say if we open above on a PPI move over 602.50, any consolidation back up here, again, this is where something's like not really adding up. These sellers, in theory, start to become pressured, right? They're like, okay, we closed weak. We finally got the breakdown underneath the morning low. We've got a red bar. The gap up failed, right? Why are we opening back above the origin of this breakdown right here, ultimately? The morning lows at 602.50. I would think the pressure's on, ultimately going back to the previous day's high. Then the trade you would be looking for is the Brigade bolt out of range into the next level overhead, which is at 606.75. Right? Beyond that, we have the upper edge of the weekly expected move, 608.40s. Then the all-time high is really up there at 613. Not calling for that, of course, but I'm just pointing out those are your upside levels. So once again, base case to me seemingly would be an open in here that remains somewhat tepid and weak. And I think another thing to call out here is if you've been watching price intraday, this entire advance these days, Monday, Tuesday, and even early on in today's Wednesday session, very, very timid buyers. Very timid buyers, and ultimately this liquidation break to me is the result of buyers not really getting the follow through in the upward direction and just being positioned from really terrible location earlier on in the session. So once again, base case probably looks like this. This is a quick scalp, and then really looking to see if we can pick up longs off that 595.15, then trading back in the upward direction after setting something that would represent a daily higher low. Why would that be a daily higher low? Because we would have on the hourly highs, lower highs perhaps. This is the most important move right here. Underneath this level brings in a lower low. Once we have the lower low on the hourly time scale, the daily higher low, firm higher low can be satisfied. So that's what I'm watching for on the S&P 500. Again, with respect to the QQQ, if we just quickly go over here, we absolutely have, once again, here's your look above and fail. Lower highs under 533.25. You could either look to play short off of that for risk and reward like this, or if you'd prefer a little bit more confirmation, right? If you really want overhead supply, you want all of these traders ever since last Friday to be trapped overhead. Then you want risk here, reward to the downside off of 529.75 trading into 522.50, which is that big bad daily level. When and if we get there, that of course is an equal low on the daily, and this is, well, it's an equal low to the soft daily higher low from back over here. So that's how the two indices play together. If the NASDAQ ends up opening, let's just say based on a positive PPI print, over 533.25, once again, it would leave me with, I'm not going to be scratching my head, oh my God, I can't believe that, but it just makes me a little hesitant about trying to force big continuation downside out of this pullback if the sellers failed on the first go around, right, for the liquidation break, finally got the second one. If they can't make anything happen here, I really wouldn't press the bet to the downside. I think that, this sort of flush, if you will, from today's session starts to give new longs better positioning, better posturing from back here. I think you've had the opportunity to perhaps flush out some of the air quotes. I'm really not a fan of these terms, but the quote weak hands who are long from here, people who are finally like enough's enough. I'm just going to throw in the towel on the long side, stop out and look to reestablish. Those people probably starting to feel the pressure into this afternoon on the move back down below 533.25. Let's go back to the Spiders cash though for just a second, because I do want to illustrate, right, regardless of what happened today, yeah, sure, the market's down about 0.5%, big whoop, right? We're over the anchored view app stack. If I do something like this intraday, you can just see the anchored view app from here, the anchored view app from here, the anchored view app from the Monday session of last week, which in my view really kicked off some of the cleaner price action we've seen recently. Monday, Tuesday of last week was beautiful. It's sort of gotten back to not being so great, but we're above the entirety of the stack. Another reason to not really press the bet to the downside, even though we're getting these discrepancies between the two big indices. There's some other discrepancies as well, and we will be a little bit more freeform in today's episode because of the whole internet thing. Let's see if we can get the job done with the RSP. I just want to talk about breadth really quickly, and this sort of cuts both ways. Let me just open this up like this. So the RSP is the equal weight S&P 500. Notice that it did not gap up over the previous pivot high. It has not broken out yet over the 180.15, whereas of course the S&P has gone on, the weighted S&P, if we just go back to this, has of course gone on to break out over that previous high and make higher highs. Now, if I'm a stronger seller and I'm actively trading the RSP, which trust me, I don't really think it's more of a measure of the equal weight, right? Nobody's, I don't think, really actively trading the RSP. Notice that we breached the previous day's low, the Tuesday low. I can even zoom in a little bit further on this for us. We breached Tuesday's low here, don't find follow through, close back in the range. What would that start to look like? I mean, in my view, this is another example of failure from the sellers. And if we remain inside of this range and pressure the highs, that's more of a look for a breakout rather than a sustained pullback and, oh my goodness, bears are totally in control. Remember what we were talking about in the S&P 500 weighted, the SPY cash just a moment ago? The sellers had the opportunity today to basically produce a bearish engulfer. They absolutely had one brewing intraday on the RSP, but where's the close? Back inside of the previous day's range. So it's not like, oh my goodness, the RSP must break out tomorrow. I'm just still a little bit hesitant on the major short thesis that, oh my goodness, markets are going to break down aggressively and continue this pullback in a major way. So those are some of the divergences / red flags, white flags that I'm starting to see in the market here. If we take a look at, let's jump over to our market internals. This is one of the things that would continue to reinforce as well. It doesn't really seem like a big new money short to me where, oh my goodness, we should look for the market to go to zero. If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. It'll explain what all of this is. But for the most part, if I just throw on the clean drawing set here so we can see, right? The previous day's close, Tuesday's close, was near sort of the midpoint of the range, right around in here. So as the breakdown, let me zoom in on that actually, right? The close of Tuesday is right here. So in theory, into today's close and really into the afternoon, ever since this breakdown took place around late afternoon, 1:45, 2 o'clock, there's a nice lower high under it into the afternoon as well. You would think that if we had more of a bearish tone across the exchange level, then this would have gone substantially more negative into that 2 o'clock time frame. Now, it did go to the zero line, but was it anywhere close to the trend lower zone / substantial volume outflows? The answer is no. So something like this would reinforce, okay, this is still just a mild pullback. It's one mild down day, about 50 basis points, 0.5% to the downside on really neutral internals. The advanced decline line, it did end up going slightly negative here. Intraday, of course, this is going to read red because we're underneath the opening print, so that makes total sense. That index score would flip red. But look at the tick as well. The tick into the afternoon getting very, very volatile and only barely being able to close the cumulative build underneath the zero line. So the more I continue to dig deep through the data points here, the more I think to myself, it's not clear that the market wants to fall out of bed and, oh my goodness, go to zero. But we still have some red flags, white flags with the QQQ divergence. The RSP technically still hasn't broken out, although it was unable to produce a bearish engulfer. And I think the bottom line, again, I'm going to sort of try to make this as actionable as possible, is just we don't want to over-index on the bear side. It still seems like buyers are in control. Here's another data point, actually, by the way, which feeds into this. It's actionable here, and I'll continue to explain this. This is the market profile for anybody who's not familiar. Check out the video tutorial in the top right-hand corner. Where was the value area and where was the point of control on today's session? Value area was higher, point of control was higher relative to the Tuesday session. If we had stronger sellers, what should their objective be? Let's bring value lower. Did that happen? No. Point of control is over the midpoint of today's range. So this data point as well is another push and pull that doesn't really align with, oh my goodness, market's going to fall out of bed. But it's also, where did the market close? Here, underneath the point of control. So is this trapped overhead supply? It's possible. So again, the actionable takeaway from all of these conflicting data points is to control your size, not be overly biased one way or another. Come into the session, I would say, on Thursday and Friday with a very open mind, willing to trade either direction. Because honestly, it's not that bearish out there. I mean, yes, the market pulled back. We've been used to this grinding sideways market. We finally got a little bit of range on the session, right? Oof, look at this, tough range. If we go back to the Monday session, oof, tough range, really like watching paint dry. Friday, watching paint dry. If we go to Wednesday of last week, watching paint dry, right? So finally, we got a little bit of spice, a little bit of volatility intraday, but is it enough to cause a huge market reversal to the downside? I don't see it as being a major thesis here for the S&P 500. And once again, keeping size controlled, not become like the last thing you would do, again, an actionable takeaway. Please don't short the market straight into support. That wouldn't make any sense. If the market's still giving us this push and pull, if it's not quite clear that sellers are completely running away with it, then as we approach support, we should be thinking about wrapping up shorts, not initiating new money shorts, right? Can we find buyers here? Do they step up at the exchange level? Can we get something that looks like this? So that's where my head's at between the two major indices. I feel like we've done a pretty decent job of covering the QQQ NASDAQ. You know the game plan over here as well. If we're underneath 533.25 in the NASDAQ, absolutely that's look above and fail. And theoretically, the target should be 522.50. I would really start to trade that when and if we get the drop underneath this anchored view app, and when and if we get the drop underneath 529.75 with the Brigade Bolt to manage risk. If we can do this, great. Looking to balloon runners here, fantastic. That would be the next follow-through move. If we are to just see something that opens above 533.25, I would just put the bear thesis to bed. I would not over-index on the bear side of this market. NASDAQ internals, let's quickly check in on those as, again, we take a little bit more of a free-form approach on today's session. Same story where the volume flows for the NASDAQ hardly get negative into the afternoon, actually closing positive there. If we look at the advanced decline line, definitely a little bit more negative impression happening over here, and the cumulative tick is the exact same as the S&P 500, hardly going red into the afternoon session here. Taking a look at the market profile for the NQ, where was the value area and point of control? Let's see if we can get this straightened out. There we go. So this also very, very telling. If you just take a look at last Thursday's high, there it is. Do something that looks like this. Value area is above, point of control is above. Stronger sellers, what do they want to see? Technically, they want to migrate all of this stuff lower to basically initiate a thrust lower from price. So, you know, in my view, it's got to be this breakdown here, closer to the 21.740s, 21.750s. If you start cracking that, I would start to become a little bit more interested to the downside. The other thing that I'll just point out here really quickly, there's huge excess A period here, excess E period here, excess J period here. So at the bottom end of the auction every single day, for the last 3 days at least, Monday, Tuesday, today's Wednesday session, we've had decent excess on the lows, which would mean that the auction ended properly, and these should be secure. right? Now, they are fairly equal, which would make them weak in some sense. So we're still watching that level. And once again, this equivalent around roughly 21,740, if we just go back over here to the QQQ cash, is of course going to be right around in this zone around the 529.75 mark if you're using the cash market here. Okay, that is your NASDAQ look. Let's take a quick look at the small caps and see what's going on with RTY/IWM. If we move over here, more evidence to me that suggests that we still want to maintain an overall bullish stance. Now, if you're looking at the trend, we have lows, higher lows, higher lows, higher lows, firm higher low here. This is a firm higher low, believe it or not, although that looks more like a grind. It is technically an hourly downtrend via the lower lows. This is the highest high, and what has taken place, right? We've been talking about this over and over and over again in the pre-market prep. We do have a breakout of this major inverted head and shoulders neckline, which was also a minor inverted head and shoulders neckline right here on the hourly chart. And I would really say that any higher lows on the daily time frame over 209.75 could repair some of the structure below us, aka these unfilled gaps. If I zoom in here, you can see the unfilled gap here. You can see the unfilled gap here. If we repair that, no problem. Can we pick up buyers on the major neckline retest 209.75 and then rotate in the upward direction? We do have more of a bearish engulfer out of the IWM daily bar here. We closed underneath Tuesday's low. We're also rejecting the daily 200 SMA. It's very reasonable that after getting a substantial breakout of the minor inverted head and shoulders, which basically hit the measured move from here to here, a little bit further would have been the full measured move, but for the most part, we're home on that target. If this comes into the 209.75 and pulls back for a higher low, you just have lows, higher lows, beautiful opportunity for a higher low. So although the Russell could pull back and maybe offer slight dampening to the S&P 500, is it the end of the world from a trend perspective? No, it's actually quite bullish, offering the next higher low in the trend count, which is the next best spot for stronger, more committed new money longs to start getting involved. So I like that here on the IWM. If we take a look at the hourly time scale, you can see here how, again, the afternoon breakdown does close underneath the Tuesday low. So it seemed to me that any acceptance below the 213.90, is starting to kick off more of that downside move, and we'll just be watching. How do we close this gap? If we fail to close, like let's just say that the market hangs out here and then pops back up, I mean, that's just telling you everything you need to know. If the market can't close this gap, if the market can't close this gap, who's in control? Buyers. Do we want to be big bears over in the S&P 500 if the small caps are breaking out of a major weekly pattern? Probably not. Probably not. So everything's A-okay here on the smalls. Let's take a quick glance at the intraday anchored view apps, or above the entirety of the stack. The bottom portions of the stack, so this and this, will start to add confluence over time, right? Perhaps early next week at the 209.75 retest if we get there. So just be thinking about this through the lens of the daily chart. Brigade bolt here, higher low, looks good to me. So offer the pullback, that's fine. A little bit of softening in the S&P 500. We know there's push-pull. We know we're sizing down. We know that we're not shorting into support, basically. I'd say the same thing here on the IWM. I wouldn't be short into the 209.75. I would be closing shorts here, if not looking actively for longs to pick up the next leg in the upward direction headed back higher. Let's quickly check in on our Rusty Russell market internals, and we'll see what's going on here. A little bit firmer of a red close on the volume flows. If we look at the advanced decline line, just sort of similar on par read to the NASDAQ there, and definitely much more of a bearish build here on the cumulative tick. So sellers definitely take the cake in the Russell Index, which I think is honestly not the worst thing in the world, considering that it's most recently seen a breakout in the upward direction. It can offer that higher low pullback, pulling back from the highest high. If we look at the RTY futures to quickly get a sense of market profile, what do we see over here? Let's maybe get that a little bit cleaner on the screen. I just want to see, yeah, there we go. Main point, it's this overnight high from CPI that's throwing everything off. We want to see if there's a poor low. There is. So unlike the S&P and the NASDAQ, you have a poor low on today's Wednesday session, which could be in need of repair. Obviously, another discrepancy here is that the value area and point of control absolutely migrated lower with price. So I would think that if the Russell is going to lead the market, right, it's offering some idea that the pullback can ultimately continue. Now, again, watch those gaps below to determine how aggressive we should or should not be in the S&P 500. If the Russell starts closing this gap no problem and moving into something like Friday's range of last week, then of course soften the expectations for upside in the S&P 500. If the small caps are doing something like this and then starting to get some love on, let's just say, an intraday hourly close back over something like 213.90s, then great, we're still going to maintain that optimistic and bullish stance in the S&P itself. Let's get into some sectors where I think we continue to see a lot of the same commentary here. So remember that the S&P is pulling back from the highest high. So where's the sector performance this week? Well, energy leads the pack, up 3.05%. That is typically rotational and would offer more of a risk-off style look. When energy outperforms the market, typically it's offering a market pullback here. So as we get a down day today, does that make sense that energy is up 76 basis points versus something like the tech sector here, down 46 basis points? Yeah, it makes sense to me. So rotation is definitely out there. You are seeing the sectors continue to rotate. It's not like everything was red from the open today. You do have little spots of green in here, such as the healthcare sector, and even names that are just not down as much, right? Obviously, discretionary taking a little bit of some brute force there on the Tesla move today. But if you look down at the bottom, what you'll notice is something like staples are technically outperforming the S&P by being down less, right? S&P's performance is right here for the session. The XLP is right here. Okay, so generally the risk on, risk off rotation continues. And right now through the pullback, it seems healthy to me that the market's doing what it's doing. If we look at semiconductors up on the week, another sign to me that is just like totally, why would you short them? Let's start with the SMH chart. Let's just start here for a second. Let's have a look. What is this? That's a breakout. That's a successful breakout. It is plenty of room for a higher low. And honestly, on today's session, not even coming close to the Tuesday low, offering a lower wick at the bottom of today's move, staying over this previous pivot high. When I think, again, through all of the data points we've looked at so far in the S&P, it's really tough to build a bearish argument that, oh my God, this pullback needs to continue and offer some devastating blow of like down 5% in the S&P 500. Could that happen again? Oh, anything can always happen. We all know that. But when we play the probabilities game, this doesn't really stack up as a major bearish data point. It's like, okay, we're holding up over the top end of the previous range that we've just broken out of and cleared. So in my view, even if we were to break down here, I'm still on the lookout for a higher low over 249. That would start to look like a firm daily higher low if the hourly trend flips down to get there. If we consolidate here for a number of days and then break down, maybe it's a weekly higher low. Really no concerns with this chart. As we take a look at the energy sector, again, speaking of rotation, you are getting into this equal high here. So energy breaking out higher, closing the gap. The gap's technically been closed for a little while now. But 86.65 equal high from over here. Let's take a look at crude. We know crude is broken out over the neckline of the inverted head and shoulders. Massive uptick on today's session via the CPI report, really. And the fact that inflation is not really showing up as a big deal. We'll see if that changes. Obviously, higher crude prices would impact then inflation in the future. So we'll see how that ties into the growth narrative as well, the whole R word, recession, and if we need to bring that back up. But for now, crude breaking out, bullish in terms of the recession narrative going bye-bye. Let's take a look now at the discretionary sector. And you can see here that we're doing absolutely nothing, stuck sideways in the range until it breaks down to close the China gap and is at least in the China gap. I can't be bearish here. So yeah, it might not be bullish. It's not continuing in the upward direction, but it's definitely not bearish. Just because something's not bullish does not mean that it's bearish. Let's look at the TLT, slightly higher as rates come in today on the expectation that, okay, tariffs and maybe inflation's not going to be as bad as we think. Bonds get a little bit of a bid. And of course, what do we see out of the 10-year? Opposite direction, moving slightly lower today. If we look at healthcare, more rotation happening over here, getting a little bit of a curl higher. I would love to see it spend a little bit more time over the daily 50 SMA, really clearing this previous closing high from back here. Bit more clearance, higher low above, spend time in the upper third of this balance range, and then break out. Probably offers sustained bullish rotation for the S&P. Tech sector, right at the all-time high. Again, I just don't see the big argument for being a major bear. If this is going to turn into a massive weekly double top, just remember your weekly neckline's technically way down here. So you'd need a daily reversal before you even start thinking about a weekly double top. Any consolidation in this zone, let's think about building blocks. Go back to playing Legos like you're a kid. Block number 1, block number 2. Anything that stays over 235.75, you've got a stair step in the upward direction. You're building with Lincoln Logs, and you're off to the races on a Brigade Bolt over the all-time high at 242. Very tough to be bearish when the heaviest weight risk on sector looks the way it does right now. As long as we're over that 235.75, no issues on the tech side of things. If we look at real estate, a little bit of love in the upward direction today. Still rejecting the daily 200 though. When it makes a new pivot high, typically get a little bit more interested. So that started to unfold today. It wasn't really sustained. Mortgage demand was cited as being elevated in the last report, week over week. So as rates perhaps come down a little bit on the softer than expected inflation report, if we see rates come down, we want to see mortgage demand go higher, which basically means that people have cash on the sidelines. They're sitting, they're waiting for lower rates, and then they're going to deploy capital. If mortgage rates come dropping down out of the sky and nobody wants to go out and buy a house, that's a red flag. So mortgage demand seeing an uptick like we saw in the headlines this morning and based on the report, all set, no issue there. Let's take a look at communications, continuing to accelerate higher out of this as a flag breakout there, headed towards all-time highs. Again, pretty tough to be a bear when you've got charts that look this way. If we move along to materials, the lightest weight sector, it's making a new pivot high. It's sort of staying a little bit tame underneath the daily 200. Not overly concerned with this chart. Even if it were to fall back down into range, it's not heavy enough weight to really cause an issue in the S&P 500. A divergence that you might pay attention to is the XHB. Speaking of home builders and rates, it's just obviously well off of its previous high here. The only thing I would just call out as a higher time frame watch is this a higher low double bottom from a weekly perspective? If this is a higher low weekly double bottom and we get over this neckline with acceptance at $100.50, then I think the R word, the recession narratives, again, just goes bye-bye. It's not really going to be a big issue if home builders catch a little bit of a bid and the cyclical side of the economy comes back. Now, let's not forget that overall here, the trend is absolutely still in the downward direction, but it's trying to change, right? It's trying to go lows. It's trying to go higher lows. We know if this is going to be a double bottom, it's only a double bottom when and if we break the neckline. So just like I won't speculate about the big double top on the XLK, I'm not going to guarantee that this moves anywhere until we actually get up and over $100.50. Let's move along to industrials, making new all-time highs later last week, sort of fading off a little bit from that. No issues, still offering, we want a trend line here, semblance of a higher low set there. If you pull back and stay in this range, that's still A-okay from my perspective. Intraday, intra-week, sure, could it offer a little bit more chop and balance as we go sideways? Yes, of course. But general concerns, no. Let's take a look at the financial sector. Hasn't really gotten in gear, and I'd love to see it get in gear up and over something like the 5165 for a sort of Brigade bolt look into the all-time high. If that happens, it's going to continue to fuel the rotation from the risk-on sectors in your S&P 500. Remember that financials are now the second heaviest weight sector by market cap, so watching that very closely. Utilities, the most defensive sector, pulling back sideways, not really doing much here technically on the week, down about 17 basis points as the market literally gapped up to a brand new higher high today. Is this a concern? Answer, no. Let's move along to XLP. Same story basically as the XLU. Sentiment-wise, risk-on, risk-off-wise, it's not an issue sideways in the range as the broad market's gapping up to a new high. You don't want staples leading that anyways, so all set there. If we look at the ratios, what we'll find over here is a sustained bullish and risk-on look. XLK outperforming. Do need to see some pickup here from the XLY. We'll go neutral till day there. XLV is hanging in there. Remember, we don't want it falling off of a cliff. It's the fourth heaviest weight sector. Financials need to pick up the slack here. Let's put an X on the XLF ratio chart. If we look at risk off, though, XLP is still certainly in a downtrend. So there's definitely nothing concerning there about a risk off rotation. Same thing with utilities. It's technically in a downtrend here. If we look at the specialized ratios, risk on off A, you could see bullish, you could see bullish, you could see bullish, you could see bullish, bullish here, absolutely in the ARC K, breaking out and getting some follow through. And even the Russell growth versus value is pulling back into a higher low. So all set on the risk on off A, B. Let's take a look at B. What do we see over here? Gold is not really outperforming in a substantial way. This downtrend is still technically intact. If we look at Bitcoin, the Sailor Shift tool is fired off back to a red signal. However, we all know that the way you trade that Sailor Shift is if you break the previous week's low. Or if you don't know, that's now you know. So if you break the previous week's low, then of course this just looks like a double top, right? You have a daily double top here. You're under the neckline, and then we trade into the 92, looking for a higher low at that point. After a little bit deeper of a pullback relative to this, right? There's your higher low here. So keeping an eye on the Sailor Shift tool, but for the most part, consolidation up here looks like nothing more than a bull flag, which is bullish because, as you know, Bitcoin here, on the channel at least, is seen as a risk-on asset, not a defensive hedge, not an inflation hedge, not a store of value. It's a risk-on asset. TLT ratio to the S&P continues to remain sideways down here towards the lows, increasing risk appetite for the equities market, not the bond market, which is seen as risk-on as well. If we look at the dollar and interest rates, a little bit of a rollover here, a little bit of a rollover here. Better than expected CPI report will do that to you. If we take a look at the inverted ZT, which is the Fed, closely tracks the 2-year yield here, you could see the rollover, which once again makes sense that the Fed would just sort of be pause or maybe even cut. Cut is if this moves substantially lower for the next meeting, which is ironic because if we go back over here and take a look at the Fed tracker tool, in a weird way, right, you would think that the Fed has basically said, We're really concerned about inflation and tariffs, and we just want to keep policy in a very flexible spot in case it starts to show up. We don't have to hike rates again, right? So why on earth, with a soft report, did the Fed funds futures start pricing in? And, keep in mind, this is like a sliver of a sliver of a sliver of a sliver of a sliver's percent. But why is it pricing in 20 basis points of a hike now relative to the 99.99999% odds of a pause that we had prior to the CPI report? A little bit of a head scratcher. I would have expected that these odds also firmed up a little bit, and you would have seen more like a secondary cut in October, not getting pushed out here till the end of the year. So something like this jumping over here, and that way you have cut 1, cut 2, pause into the end of the year. So we'll see. I think PPI holds the key tomorrow. If PPI comes in lighter than the expectation, I do believe that these odds should shift meaningfully towards the direction that I've just outlined, basically on the premise that tariff inflation just simply isn't showing up yet. And the lower inflation goes, we went through this exercise in the pre-market prep today. Let's see if I can just draw down here on the white screen. The lower inflation goes, let's just pretend that this is the curve of inflation, right? Something that looks like this. Inflation's technically coming down right now. It's stalling out a little bit, but it's technically down. The Fed funds rate went like this, right? Okay, we're going to sort of battle inflation. We get inflation down, and the Fed funds rate held. They cut 50, they cut 25, they cut 25, and now they're holding. As this distance grows, and I know this is not drawn to scale, so please bear with me, this represents the real rate. The real interest rate. So if the Fed funds rate is currently, let's just use easy math, right? Let's just call it 4.5, the top end of the range. If the Fed funds rate is 4.5 and inflation just came in at 2.5, right? Obviously, we have a real rate of about 2%. So as inflation falls, let's just say that inflation goes to their target at 2% and the Fed does not act at all, real rates technically do what? Real rates are at 2.5%. So I believe that the Fed will have to start getting, a bit more, further away from the restrictive territory should inflation continue to come down. With the situation in labor, I think that they should. This is subjective. This is my take. We'll see ultimately what they do, but and we'll learn a lot more next Wednesday, actually, when the FOMC and SEP are released. But if they're continuing to keep rates stable as inflation comes down and the real rate is getting higher, it's technically tightening monetary policy. As we know, the labor market is softening, right? Hires are technically down. The 4-week jobless claims trend is technically up. I think it would be to ignore the progress made on inflation, I think is a little bit of, dare I say it, too late, Powell. We don't want to fall totally into that bully category, but you get the idea, right? That's the general gist out of the Fed funds rate as of right now. Let's take a look at how the data came in here. You can see on this view, there's your beat, specifically on the core CPI month over month. This is a massive beat, right? We know that sustained a 0.2 is okay. That sort of keeps us not bad. It'd be best if we had a couple of 0.1s mixed in there. So to go from a 0.3 expectation to hit a 0.1 on the actual report, really, really solid read there out of the core CPI. If you take a look at the year over year non-core, you're at a 2.4. And if we take a look at the core year over year, which is right here, a 2.8 versus the consensus view of a 2.9 as the expectation. So beating across the board there on the inflation metrics. If you take a look, there's really, this is the non-detailed report. All items you can see here are up about 0.1. That's your month over month that we just looked at. If you take a look at food is a little bit inflationary here. Energy, deflationary, down by about 1% as we head into the summer months, which is kind of interesting considering electricity and perhaps cooling costs. Electricity is technically up about 90 basis points there, but net down, specifically out of gasoline. Big move there. We know that energy is volatile, so is food. So all items less food and energy, hence core, is right there as well, 0.1. Not bad. If you take a look at shelter, coming in at a 0.3, that's pretty stable. You typically do see shelter hover between the higher ends of the read. Remember, shelter represents about 50%, not quite exactly 50, but roughly half of the inflation report comes from shelter. If you do want the detailed report, you can see here, rent of shelter is over here at a 0.3. Rent of primary residence, which is basically just analyzing mortgages, is right on par with the month over month. That sort of equates to a 2% read on the CPI print itself. So no issues out of that. You can continue to go through this if you'd like. Some funny ones we were looking at this morning. Steaks are technically down. If we scroll up, and we can find them real quick, beef steaks down about 1.1%. Go out to a local restaurant, ask for a deal. Tax services towards the bottom are also down Not going to waste too much time. If we can find it quickly, cool. If not, let's move along. Tax return, there you go, down about 2.3%. Go ask your accountant for a discount as well. Moving into the remainder of the show, what do we have here? PPI, looking for a 0.3 and a 0.2. That's the month-over-month reads. If those come in lighter than the expectation, I would expect that the Fed funds futures start to price in, again, more of either a pause or those odds flip from the hike, which is really bizarre to me, but down towards a cut, right? Maybe we go like 95% odds of a pause, which is still the most likely outcome, but 5% odds of a cut, just to signal that at least the market's responding to the data favorably. Unemployment claims will be a big deal. At 250, we start to get major concerns here, and the Fed should start thinking about cutting rates should we start breaking out on the jobless claims. We'll be watching that very closely. And don't forget, we do have the consumer sentiment and inflation expectations, 10 o'clock on Friday. The market always responds and reacts to that quite a bit, so please be aware of that intraday. 30-year bond auction usually does not move the market as much as the 10-year, because the 10-year is what most things are priced off of when it comes to interest rates. Looking at the earnings calendar, you can see that after the close, we got Oracle. Oracle gave a double beat, as you can see here, exceeded estimates for the previous quarter. You can also see that they offered very positive guidance, jumping revenue more than 70% looking forward, up from the 50% growth that they had in 2025. So positive guidance. You can see here, look at this little bullet. The stock popped in extended trading. Okay, you could say rallied perhaps. Shares climbed 8%. So Oracle higher in the after hours. I believe 190 was the last I looked. As we head into the remainder of the week, Adobe, Restoration Hardware, those are your next two heavy hitters, if you even want to call them that, into the end of the week for the S&P, at least in terms of market-moving names. Let's jump back on over to the platform. Let's finish up our analysis here. Bonds, relative to themselves, are looking A-OK. Remember, if this goes sideways, no problem. The Fed's not going to, the Fed's not going to be responding to a broken labor market already. If this really starts to spike, that would be an issue. If this starts to go higher again, that's more of an inflation response. So the fact that it's tame and mild today does make a little bit more sense. If the longer end of the curve comes down a little bit, that would be a relief, a sigh of relief from the bond market, basically saying, okay, maybe this tariff situation is not going to be as bad as we think. Speaking of, we did get the 55% deal, if you even want to call that a deal, with China this morning. That was a pre-market tweet, although the market seemed to brush that off and it was totally trading organically intraday. Liquidation breaks driving the way. If we look at the LQD and the HYG, as credit spreads, right, proxies are moving lower, which would indicate heavier risk appetite for equities down below. All set on that. That's a little bit more of a bullish stance that we have. Let's take a look at junk in isolation, really struggling to make new highs. So again, it's one of those divergences that aligns a little bit more so with the QQQ saying we just want to be really cautious of being a big buyer at the all-time high, or not the all-time high, but rather the highest high of this trend count. And more so, we would look to exercise patience, look for the pullback. If we can support off of a key level, and this is not totally blown up, meaning making a new lower low under here, then we would probably maintain a more bullish and optimistic stance for follow through in the upward direction on the S&Ps. If we take a look at breadth, there's that subtle sort of divergence we mentioned in the RSP, not breaking out, new highs versus lows, a small downtick on the week, but nothing major. One of the divergences that we talked about in the weekend episode was the fact that this was technically a lower high. This is still a lower high, as your S&P is technically climbing and making a higher high relative to this, right? Still in play, still divergent, not enough for me to go out there and short the market with both hands, but we're open-minded. We already talked about the RSP, but once again, it would be best if the RSP could stay inside of Tuesday's range and break out over 180.15 if we're looking for follow-through out of the S&P higher. If this pulls back in here, it's not the end of the world, but I certainly would not be fishing for new money longs in the S&P at the highs. Let's take a look at the volatility index, CBOE volatility index, or the VIX. We've got a little bit of a doji, indecisive on today's session towards the lows. The bigger red flag here, which again adds up as being a bit of a head scratcher, is this. If you take a look at the VVIX, volatility of volatility, it's technically substantially higher on today's session. And VVIX typically leads the VIX. If the VVIX starts getting up here, it would make me think that people are starting to put more hedges on in the VIX, which in theory starts to pressure, at least it's cause for concern in the S&P 500, right? So the VIX moves basically on the VIX futures pricing as well as the 30-day options in the S&P 500. So VVIX moving higher indicates some option activity happening in the VIX. People are starting to put on some hedges. That means that folks are concerned about the potential for downside happening over here. With that, we can take a look at the volatility futures. and see exactly what's happening with the contango versus backwardation spread. These have about 7 days left, so it's a little loftier than what we would typically expect coming into the expiration. However, these are all still in the proper stack, with the brightest up top, the dimmest down low, and all are stacked over the zero mark. So we are in a contango, which means that money managers are comfortable allocating risk here. Same thing here out of the 9 versus 30-day VIX, and the 1-day VIX did not pop with the VIX, the VVIX, I should say. You'll notice that we're completely inside of the prior day's range. So pretty tame out of the 1 day. If this was going to be a larger issue and oh my God, we should, duck and cover, get under the desk and, be prepared for Armageddon, you'd probably see a breakout in the 1-day VIX over the 2145 handle. We just don't have that. Let's move along into our core list of companies. Let's rip through the analysis. Then I've got 3 trade ideas for you. The levels might load a little slowly here just simply because of the whole Wi-Fi issue. The hotspots make and do, but boy, oh boy, do we need to get that resolved. Tech should be coming out tomorrow to help us out with it. So, NVIDIA, what do we see here? I've got some subtle concerns about the failure, again, at the 143.25. One of the things that we were talking about earlier on in the week, is the Monday session offered a breakout that then failed. Right, and then this consolidation here Tuesday started to get above. This morning, notice the back-to-back hourly hammers there. The best thing that could have happened for NVIDIA was these hammers actually triggered up and over the 144.75, offering that big range to trade for into 149.25. That obviously didn't happen, and we closed weak once again underneath the 143.25. So, in my view, it's very tough to want to short NVIDIA in this range. I mean, look at the price action in there. And, I mean, you can be my guest, and in hindsight, right, if it does end up doing this, and oh my God, it's this big failed breakdown, then fine, you can come back to the video, you can leave a comment, and it's great. But if I'm thinking in terms of probabilities, the short really steps in when and if there's acceptance here underneath 140.50. So instead of shorting it up against 143.25 and just chopping through this range, I'd more so be interested in this risk reward, a little bit more controlled, a little bit more relaxed, making sure that the breakdown is actually in force before just getting all bared up and oh my God, the market's going to crash and burn. So that's my view there. If we do get back above this, I'd be a little reluctant to take the longs over 143.25 now. Again, opening on a gap up this morning. You had 2 outcomes, either gap fill reversal or hold 143.25, which really wasn't even an ideal outcome in the first place. You don't want to retest that after you open back above. You want to use that higher low into the afternoon on Tuesday. So this is like consolidation. Next Brigade bolt is over the 144.75, and then maybe we're starting to talk about that 149.25 as a target overhead. So one step at a time. You've really got to wait for this 144.75 or this 140.50 if we're going to do something on NVIDIA. Microsoft, excuse me, look above and fail after look below and fail. So Tuesday, look below and fail. Monday, buyers, what did they want to see? Buyers technically want to hold over that 473.35, follow through in the upward direction. Instead, we're back in range, lower high here. If the risk reward opportunity presents itself, maybe. It would have to be aligned with a broad market that's also substantially bearish, right? So if the risk reward is tight enough, if it's worth taking a crack at it, maybe if we're dealing with like this, back into the low of this pullback and then ballooning runners to the bottom end of the range. But 473.35 is the watch there as a level on Microsoft. Let's move along to Apple. Apple breaking its balance range here underneath the 201, underneath the 200. So the name of the game is rally rejections under 200 continue to offer downside pressure on Apple. If you look at the daily chart, right, remember that it's still in this range as well. So yes, you're breaking down from this nuanced midpoint, but really you haven't gone anywhere on Apple, and I would not maintain any sort of major stance directionally on the chart until we break out of the larger rectangle there. Let's take a look at Amazon. Amazon, the best opportunity of Tuesday, really. Great little hammer here off of the 214.50. Great little rally. This morning, unfortunately, straight to the level and through the level. So what is that? It's now a double top. You're under the neckline. Sustained consolidation below 214.50 offers this. So risk reward, perhaps, if you're interested in that idea, or if you want to be a little bit more precise, you're looking for something along these lines. Risk and reward like this first into this level, which is right around 210.65, the low of what would that have been Friday session from last week. Okay, that is your Amazon trade, but keep in mind the important thing here is if you want to be bearish Amazon, you just have to remain under the 214.50. Why? Because it's the daily breakout level. If we're below the daily breakout level, bears technically have the edge on an hourly double top. Let's move along to Google, and this is the opposite, right? So you're over the daily breakout level happening over here, the OpenAI deal really fueling things on that Tuesday morning session. If we could find buyers early in the session tomorrow over 176.75 with a broad market, S&P, that's also moving higher, or perhaps the NASDAQ is back over the top end of its range, let's just say it's over, right, where it failed today, then I would be looking for Google longs, right? Something that does this back into these equal highs, simple previous high, Brigade bolt here, trade back into the equal high. How do we get there? That's the name of the game. So do we find an intraday 5-minute inverted head and shoulders, hammer candle? What's the name of the game? Some sort of buyer stepping up 176.75. Opening below 176.75 and open down here, I would prefer to look for the Amazon short rather than look for the Google short, if I'm being honest. Although, yes, this is a similar idea, the Amazon chart makes a little bit more sense because the daily double top is more firm and your neckline is much cleaner. Let's move into Meta. Meta is starting to crack the bottom end of its balance range here. Look above and fail to start the day, and now sitting on the lows. If it does break down, again, I would not be short Meta, and the reason here is if we go to the daily chart, look at this thing. It's a monster. Huge upside move, consolidation, huge upside move. Consolidation persists over 682. Really, it persists anywhere over 661. We've been talking about that level for a long while, but so to get here, I don't really think is a lucrative short opportunity. I'd prefer to trade something like Amazon, which has not been a market leader, at least in the same sense that Meta has been, and it's also got much more of a clean level in terms of a daily failure point that you can use as a reference. So Metaverse, technically you could track the 694.75, but I'm not thrilled about the intraday action on it as a short. Let's move into Tesla. And a big recovery effort over here, of course, off of the major lows from the Elon-Donald breakup. But for now, the main thing, excuse me, apologies, my apologies. It's like the internet goes out and everything starts breaking, including my voice. The main thing to watch here is the overhead supply from the daily balance range. As long as we're underneath that, the sellers technically have a lower high on the daily time scale. We were talking about this in the pre-market prep this morning. If Tesla pulls back, that's fine. The next thing that the buyers need, though, is a daily high, or it would be a daily high or low because the hourly trend is flipping to down. But the daily is off of this double bottom reversal here. It can sustain a higher low on the daily chart over 311.25, the origin of the breakdown from the, call it the breakup day, whatever you want to call it, the volatile day last Thursday. If we're over that 311.25, that to me is a pretty reasonable spot for buyers to try to step up and catch for a higher low. And as we know, what goes straight up can oftentimes come straight down. It can also go straight back up. So if this structure remains thin, let's say it's an aggressive and volatile breakdown tomorrow morning, when and if we get here and the buyers do step up, I would be thinking about risk reward. How can we exploit that back in the upward direction? So that is Tesla in a nutshell. That's the main idea. If we do just get consolidation that hooks back up here, the next watch is, can we Brigade bolt back up and over the 334? Once again, thin structure. Can we retrace that into the 349? So Tesla should be a top watch because of the way that the market is structuring on the current levels. Let's take a look at JP Morgan for financial sector. You're over the top end of this range. Once again, I don't think that financials are a big boon or a big sort of drag for the S&P at this point. For now, if we're over the 266.50, I'm just using this as a consistent reminder in the core list to not get overly bearish when financials look good like this. So for now, it's just higher lows, possible higher lows over 2665. And if we get something that Brigade bolts the 270, it's rock and roll. All-time highs are really up next. Let's take a look at Netflix. Stronger pullback on the earlier stages of the week. However, firm recovery. This is honestly one of the more impressive charts I've seen. It's one of the newer market leaders, of course. It's been leading the market out of the depths of the tariff turmoil, if you will, never really flinching on it and straight to new highs. The big watch has to be the 1210. 1210, 4 digits here on Netflix. We could stay over 1210, looking for the rotation here, and that would totally negate the opportunity for the exact opposite, right? Which was this. Remember that in the morning session we were talking about, instead of the right shoulder here, sellers wanted to keep that right shoulder here. Reject the I keep saying 212, it's 1210. 1210, reject the 1210, come down, build this consolidation right shoulder, and then flush the neckline. That was going to be a threat. That was a major threat to the chart here. However, just straight shot rally higher today over 1210, we'll get it right that time, now sets up the opportunity for a recovery, higher low, and start rotating back up towards the highs. You have a weekly/daily higher low that's brewing here off the 1183. Let's get into these additional trade ideas. The first one is on everybody's favorite, Palantir. PLTR. Let's go to the daily. As you can see, the daily structure doesn't look great, right? This is an inverted hammer, larger upper wick. However, go on down to the hourly time scale. Still, upper wicks. Oh my God, it's so scary. It's only scary if you're not prepared to potentially use previous areas of resistance as possible newfound support. So I would be watching Palantir for a potential pullback to continue. We know that there's upper wicks up here. We know that the daily bar has that upper wick. If we can get the pullback to continue into this zone between 134.65, 133.50, Seems like a great spot for a Brigade Bolt. And this is a classic, should always be on your radar. This is a textbook, put it in your technical analysis 101 trading playbook, right? Break previous all-time high, pull back to the previous all-time high, use it as support, Brigade Bolt. There you go. Call it whatever you want to call it, right? We've trademarked the Brigade Bolt, so that's what we'll stick with, but I'm sure, as you know, there's tons of names for this. Brigade Bolt, high or low. 133.50, line in the sand. If we're above it, looks good, looking for a higher low. Continuation. Next up, Broadcom, AVGO, another fan favorite recently, another new market leader. What do we have? Well, this pullback to the 242 level was ultimately it, this origin of the breakout here ahead of earnings. And now look at the afternoon consolidation and compare Broadcom to NVIDIA, right? NVIDIA pulled back and is underneath its key level. Broadcom rallied and is over its previous key level at 251. So thinking about relative strength, relative weakness, if this is going to go cup and handle and break over to close the earnings gap, I mean, rock and roll. I think more appropriately, I should have done a little bit, just a little bit more homework here by popping in some of these earnings gap levels. Let's put the yellow there and let's duplicate that. We'll bring it up to the low of the prior day session. There you have it. If we can get this gap close overhead, it's definitely a lucrative range to be trading for. So there's scalps available here out of Broadcom to close this gap as long as we're over 251. So watching that very closely, if we're back under 251, it's a little bit less interesting. I wouldn't be short Broadcom because, as we know, it is a market leader currently. The last one's going to be on Shopify. SHOP is the ticker here. Let's go to the daily time scale. And the daily chart, right, there you go. Inverted head and shoulders, neckline breakout today. Decent pullback, very similar to Palantir with the upper wick. If we take a look at the hourly chart, again, very similar here. If we pull back into the 212, 211.35, that's the spot. Can we get higher lows? Can we start to see intraday inverted head and shoulders on the 5-minute chart, the 2-minute chart, the 15-minute chart? Do we get hammer candles here on the hourly? Can we break those hammer highs and rotate back up to 117? That's really the name of the game that I'm watching for here out of Shopify as we start to resolve this massive inverted head and shoulders. And the beauty of this too is if we just consolidate here and there's no entry at 212, or sorry, not 212, but 112, and we just Brigade Bolt over 117, well, look at this, right? The 117 high of day today is already over these previous wicks. So if you're above today's high of day, you're in the thin structure from back here. And there's plenty of room to run into that 124.25. So you don't need to nail it from point A all the way to point B. You could get here to like halfway, point C, and still have a really beautiful trade on your hands there out of a name like Shopify. That's going to do it for today's episode of the Midweek Market Update. We'll keep you posted on any internet issues as we come into tomorrow's stream. I do believe we should be able to stream with the hotspot and be A-okay. It's not a power issue anymore. It is an internet issue. So hotspot will do. We'll see you back up in the office tomorrow morning at 8 o'clock sharp, 8 o'clock Eastern time, that is. 8:30 PPI will be released. I'll go back-to-back coffee and donuts on me. It's out of my pocket, not yours. Come on out to the show. I'll pay for the coffee. I'll pay for the donuts. All you have to do is show up. We'll build a game plan. We'll have a good time, and we'll be prepared for the session. With that said, have a fantastic rest of your trading week. Enjoy some time away from the markets when they close, and I will see you in the next one.